Good morning, everyone. Good morning, dear students. Good morning, Stephen, Karthik, Sahil. Good morning, dear students. How are you all? All are good? Okay. So, we have been continuing with this topic of security valuation since the last 3 sessions. And today it is our 4th session. We have already completed the equity valuation using different models like the dividend discount model, earnings based model, or multiple based model, free cash flow based model. Right now, we'll go for the next set of things. In fact, we have already started with the bond valuation part, valuation of fixed income securities. That's simply present value of the future cash flows. In that, what we have covered is the valuation, along with that the calculation of YTM, and after that we have also started with the calculation of modified duration. So already covered like Macaulay duration, which is a weighted average time period of the investment, whereas modified duration is the Macaulay duration divided by 1 plus YTM. But this 1 plus YTM was essentially divided by 1 plus YTM is essentially, for a 1% change in YTM, what is the expected change in the bond value? So like in our example in the previous class, we got the modified duration to be 4.30, and that was 4.30 times. So we observe that a fair estimate of a change in the bond value will be 4.3 times of the change in YTM. So if YTM is changing by like 1%, then we will observe that the bond value changes by 4.3%. Okay. Okay. So that 4.3 was basically for a 1% change in YTM, there is going to be 4.3% change in the bond value. Now, when we have observed, or when we were looking at this modified duration number, we tested whether this is truly working out to be or not. So we found that when the YTM changed from 5 to 6%, basically a 1% change in the YTM, then we find that it is, change is basically 4.18%. And what we were expecting, we were expecting like 4.3, I can say 4.3%. So there we found that there is a bit of error that we were observing, because for a 1% change in YTM, we were expecting a change of 4.3, and actual percentage change in bond value is 4.18%, which is, happening to be an error of 0.12%. Now, percentage change in YTM, when we just reduce it, like let's test it with smaller percentage, like instead of 1%, we said let's test the change of 0.1%. So there we were expecting the percentage change to be 0.43%, and the actual change also that we observed was actually working out to be 0.43. So there the error was 0. Then I just left you in suspense in our last class, because I said that there is an error when you're looking for a 1% change in YTM, but the error becomes 0, or maybe it's getting reduced when you have a percentage change in YTM to be 0.1%, right? So let's unveil that suspense now. Why is it happening that, for larger changes in YTM, there is an error in the estimation, whereas for smaller changes, the error seems to be minimal or maybe negligible. Okay. Now, to understand the reason behind that error, we'll have to work out with understanding what is the shape of the bond value with respect to that of the YTM. Okay. Technical team, I think chat, have you disabled the chat? अच्छा, chat is disabled. Chat enable रखिए, बाकी chat enable कीजिए. Chat with only the host and co-host कर दीजिए सर. नहीं तो बच्चों की queries नहीं पहुंचेगी हम तक. Enable ना, तो उसको enable with only with host and co-host करिए, ठीक है? Okay. Yeah. So now I think you'll be able to talk with me, students. Yeah. Okay. So you can post your queries on the chat. If it's relevant, I will be addressing it. Okay. So we have already covered this aspect. Therefore, a smaller change, the error is negligible, but for a larger change, we definitely see an error coming in. So what we can observe is we want to know what is the reason behind it. Okay. So let me just show you why is it happening and how do we go about correcting that part. So for that, let me just write down the YTM and the bond values. Now it is quite obvious that as the YTM changes, what will happen to the values of the bond rates? As the YTM changes, what will happen to the bond value? Yes, tell me, what's the relation between bond value and YTM? Yep. Is it direct relation or inverse relation? There's an inverse relation, correct? Right. So there's an inverse relation between YTM and the bond value. So let us take an example where the coupon is, suppose I'll take this same example. Face value is 100, coupon is 6%, redemption is 110. So coupon is 6%, face value of 100, and maturity period was 5 years. And the redemption value is 110. Okay. Now, for different values of YTM, we will definitely get different values of bond, right? So, for example, if 1% is the YTM, can you calculate the bond value, guys? Can you calculate the bond values? Yes. Can we calculate the bond value? Yes, we can calculate it simply by taking the coupon into present value annuity factor plus the redemption multiplied by the present value factor, right? Now, just for our understanding about that shape of the curve, I'll be using Excel formula over here, okay? Because we don't want to waste our time calculating bond value every time using PV factor and then want to create the graph. So just for creating that visual effect, I'm using the Excel tool, okay? So don't worry. This is something, where you're not going to be tested. This is just for creating that visual effect, okay? So YTM is 1%, NPER was 5, number of years is 5. So PMT is the coupon, which is 6 rupees, and then the redemption value is 110. So we find that the bond value will be 133.78. So let me just increase this YTM by 1%. Okay. Or maybe, yeah. So let me just increase this YTM by 1% up to suppose 20%. And now let me just get the bond values, guys. Okay. So these are the multiple values of the bond. You can just test any one of them randomly. You can just test any one of them and see if you're getting these numbers. For example, just test this 9%. If the YTM is 9%, can you just check and whether you're getting this 94.83? Please check whether you're getting 94.83 at a YTM of 9%. Calculate the value, guys. We can get it as what? 6 multiplied by present value annuity factor at 9% for 5 years plus 110 multiplied by present value factor at 9% for 5 years. Let's check. Just check if you're getting 94.83. Can anyone just confirm? Yes, Ginny. Good morning. Can you confirm this number? Pooja, Poonam, Sahil, Stephen, Usha. Anyone can just confirm this, whether you're getting this 94.83. Just check for 9%. Because once you confirm, then we'll be obviously concluding that, okay, we can calculate all the bond values on the similar lines. Yes. Calculate in your normal calculators. That should be like 6 multiplied by present value annuity factor. How much is present value annuity factor at 9% for 5 years? 94.84, is it correct? Okay, sir. So you've given me the confirmation. I accept it. Now, we have the YTM and the bond values. Now the real magic comes. Let me just create a chart for this. Here is the bond value. If you look at the shape of the bond value against YTM, what do you feel? Is it a straight line or do you see any curvature in it? Is it a straight line or do you see any curvature in it? It's a curvature, right? You can see that there is it's not a straight line, sir, it's a bit of curvature. Now you can actually, give the visual effect more by, maybe taking a 2% difference every time. So if I'm going to take, let's say, a difference of 2%, now you can see the curvature is more prominent when I'm taking like 1%, 3%, 5%. So at varying degrees of YTM, we observe that the value of the bond is definitely decreasing. Value of the bond is definitely decreasing, but it's not decreasing in a linear fashion. It's not a straight line which is falling, right? It's not a straight line which is falling. Rather, what we observe is it's a curvature. Now, because of this curvature, we were observing this error in our previous class. When we were purely using the modified duration, we were observing this error of 0.12% because of this curvature. Now, let me just take a help from here. So initially, we had a coupon, the YTM was 5%, and we were trying to change, and we had the modified duration to be 4.30. Okay. So I'll just use it over here. We had a modified duration of 4.30 times. Okay. Now, modified duration of 4.30 times. So current YTM, we have stated that current YTM was 5%, right? Current YTM at which we computed this, it was 5%. And at a current YTM of 5%, we had an observed price. We had an observed price of 112.16. When we changed it by 1%, we were finding that there was error. Correct? There was an error. Now, when I'm saying that YTM, let's take a new YTM. Suppose the new YTM is, additionally, suppose from 5 to make it more prominent, let me take it as 11%. Okay. So what is the change in the YTM? What was the change in the YTM? The change in YTM is basically it is 11% minus 5%, which is, so we are changing the YTM by suppose 6%. So going by the definition of modified duration, if there is a change of 6% in the YTM, if there is a change of 6% in the YTM, yes. So how much percentage change do you expect? Percentage change in bond value expected? Can you tell me what will be the percentage change in bond value expected due to modified duration, due to just modified duration? Only due to the modified duration, what percentage change in bond value are we expecting? Can I say it will be 4.3 multiplied by 6%? So that's like 4.3 multiplied by 6%. So we are expecting a percentage change to be 25.8%. Right? Because originally it was YTM of 5% with a modified duration of 4.3. That modified duration of 4.3 was indicating the sensitivity of bond value with respect to YTM. So if YTM is going to change by 1%, the bond value was supposed to change by 4.3%. So when I'm going to change the YTM by 6%, of course, the percentage change in bond value expected will be 25.8%. Now, if the expected change in the bond value is 25.8%, tell me, is this 25.8% going to be upward change in the bond value or downward change in the bond value? Will the bond value increase by 25.8% or is it going to decrease by 25.8%? Downward, because there is an inverse relation. So since there is an inverse relation, when the YTM increases, the bond value is expected to fall. So percentage change in bond value expected is 25.8%. So what will be the new bond value or new or expected bond value, we can say expected bond value. Expected bond value will be, can I say original price was 112.16, right? So that we are going to reduce it by 25.8%, 0.258. Yeah. So expected bond value is going to be 112.16 multiplied by 1 minus 25.8%. Okay. So that's like 83.23. Right? So you can also do it in a calculator, 112.16 minus 25.8%. So we are expecting the bond value to fall to 83.23%. But what is the actual bond value is? Actual bond value. Actual bond value at YTM of 11%. The actual bond value at YTM of 11%, we see that it is 87.46. So are you able to see the error? Are you able to see the error, guys? Is the error profound and larger now? Yes. Correct? Because earlier the error was maybe small, but now we can see the error is, very profound for a 6% change in the YTM. Right? So this is like actual bond value at YTM of 11%. Okay. Right. So now the error is profound to be possible number if you say. So error is essentially 87.46 minus this 4.23 is the error. Now why is that error over here? Let me just show it to you. Why is it the case? We computed the modified duration to be 4.3 at a YTM of 5%. Now, this modified duration was percentage change in bond value for 1% change in the YTM. Have you heard something called as slope of a function or a slope of a curve? You have heard something called as slope of a function or a slope of a curve? That slope concept is actually applied over here. that slope concept is applied, the differentiation or the derivative they say. So it's like we are at 5%. That slope is basically, slope of the curve is nothing but it's the slope of the tangent. So when you say modified duration, this modified duration of 4.3, this is actually slope of tangent to curve at 5% YTM. So this modified duration is actually nothing but it's a slope of the tangent to curve at 5% YTM. So where do we see the tangent in this case? See, this is a line that we have. Okay. And we have to make this, a tangent at 5%. So you can see possibly this is the tangent, or so tangent at 5% YTM. Let me put it properly. Like the 5% YTM is over here. This is the 5% YTM. Somewhere in between over here. Yeah. So this is the 5% YTM thing. So here we find that this is 5%. Now at this 5%, the modified duration that we computed, that is essentially the slope. Right. So let me just touch it with this line being a tangent. Yeah. This seems to be okay. So we have this tangent, the red line that we have, that is actually the modified duration line. Yes. So where does the problem lie? The problem is, this particular bond value line, bond value curve, it's a curvature. Whereas if you observe that modified duration assumes it to be a linear thing. So do you see the gap coming in between the red line and the blue curve? Are we able to see the gap that we are observing here, guys? The red line and the blue curve? Right? There's a gap over here, right? You can see as you move ahead, as you move with a greater change in YTM, there is a gap that widens up. There's a gap that widens up, and the gap is actually smaller, or it becomes like very thin line of difference when you are around 5%. So when you are in and around that 5% mark, you find that the gap is not that profound. But as we move ahead, as we move away from the 5% YTM, we observe that the gap keeps on widening. And that's the reason, guys, which I said yesterday, that if you take larger changes in YTM, like if you move from 5 to 5.1%, the difference will be nominal. The difference will be nominal, or it will be negligible. But if you move from 5 to 6 or 5 to 11 or 5 to 30, from 5%, if you shift it to 30, you can see there will be a huge gap in the bond value. Right? Even over here, we can see we observe this gap of 4.83. That 4.83 is simply the difference that we see over here. Okay, so the gap that we see, keeps on widening. So it's like you see that at 5%, the lines are touching each other. But as you move to 11%, then possibly you will find that there is this the difference that we observed, which is to be 4.83, because bond value says that the price is supposed to be 83.3. I mean, modified duration says the bond value is supposed to be 83.23. But when you look at the actual bond value, which is the curvature of the blue curve, that is actually making the bond value to be 87.46. So that's the difference. That's the reason why we have the difference. The simple reason is your actual bond value is a curvature line, whereas the modified duration line that you create, it's assumed to be a straight line. And therefore, you get that gap or you get that error term. Is it clear, guys? Why do we have the error, or why do we have that difference in the expected value and the actual value? Are we all clear? Yes. Are we clear with the reasons why we have the error or the difference between the actual value and the expected value? For a simple reason, the bond value is a curvature, whereas the modified duration assumes it to be a straight line. And therefore, you see the difference or the gap between them. Okay. Now, how do we go about improving or making our estimate better? How do we go about improving or making our estimate better? For that, we use another term. We use another term or an adjustment thing to bridge this error or to bridge this gap. And that another concept is called as convexity. Have you heard something called as convex? Ever heard this term called as convex? Yeah. Have you heard this term called as convex? Maybe way back in your school days. Convex lens, concave lens, something like this. School days in your maybe physics chapter, physics lens or the light as a chapter, right? Because I still remember my school days. I don't know about you, but yes, concave lens and convex lens, right? So convexity over here is derived from there. So if you can just recall that, what was the shape of a concave lens or a convex lens? Both of them are indicating, the curvature. Because we say that, this bond value is deviating from the modified duration value because of the curvature that we observe in it. Because of the curvature. And that curvature is going to be named as convexity. So that convexity adjustment is something that we are going to add. And we will observe that after we add the convexity adjustment, the error that we are observing here gets reduced. It gets substantially reduced. Okay, it gets substantially reduced. That for all practical purpose, we can definitely see that now the gap is properly filled up. So let me just take up this same question, because we have already done this. Let me just take up the same question for understanding the convexity part now. Okay. The convexity adjustment. Okay. Okay. So we have already got the Macaulay duration and modified duration in this question, right? So here we had the Macaulay duration. Macaulay duration was this 4.51423, and we had the modified duration also calculated. Modified duration was this Macaulay duration divided by 1 plus 5%, which was the YTM. Okay, so this was already done by us. Okay, Macaulay duration and modified duration was already covered by us. Now we have to add the convexity adjustment, and we will observe that the change that we were looking for in the previous things, when we computed the value of the bond using this 5%, 6%, and we found that error. So let me just copy this over there so that it will be a reference for us. And of course, we'll be doing the, yeah. We'll be doing the correction part also to it. Okay. Make it percentage. Yeah, this is what we have already covered. Now, how do we add that convexity adjustment? Well, when we were looking for how do we calculate the percentage change in bond value? This percentage change in bond value is computed as, or you can say expected percentage change in bond value. We have been computing this as, since there is an inverse relation, we have been computing it as minus modified duration into change in YTM, right guys? Because when we said that it is modified duration is 4.3, right? So modified duration when it was 4.3, we stated that we just need to multiply this 4.3 modified duration with the percentage change in YTM. And since this was a case of inverse relation, as the YTM increases, the bond value should fall. So we attached a negative thing. Now the convexity adjustment, or I can say the improved expected percentage change in bond value, the improved expected percentage change in bond value is obviously going to be this part. But in addition, we are also going to add something incremental to it. Something incremental is going to what we are going to add. Plus, we're going to add, to make the things correct, we'll add the convexity adjustment. Okay, so that's minus modified duration into change in the YTM plus the convexity adjustment. Now, what is that convexity adjustment? The convexity adjustment is 0.5 into convexity number into the change in YTM square. This is the additional convexity adjustment. Now, of course, I won't be able to derive this for you guys because you don't have the base for understanding this thing, because it's something derived from, again, physics part, which is something called as the Taylor series, right? If you are interested, you can check it later. You can just do a browsing for it so that you'll understand what's the Taylor series. So it's derived from a physics concept called as Taylor series, this convexity adjustment. Okay, so this convexity adjustment is added to bend the modified duration curve. Like this modified duration line, the red line, it's a straight line. We add this convexity adjustment, so there is a bending happening. So this particular line, straight line, takes a little bit of curvature with the help of this convexity. Now the question is, sir, how do we calculate the convexity? Okay, now convexity can be simply calculated using by extending this table. I can simply extend this table and get the convexity numbers. What I need to do is, I need to have a column called as present value into t, or into the time period, multiplied by t plus 1. Now again, I'm sorry, sir. I'm sorry, guys. I cannot derive this convexity formula for you because you won't be able to, grasp it also, because the basis, which is, having a basis of Taylor series or physics, is required. Right now, we just have to accept the formula as magic. Okay. So we calculate the convexity by adding one more column to our table, which is present value into t plus 1. So I can simply say this is present value into the time period into the time period plus 1. Okay, and then we just take a total of it. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . Okay, so this is the PV into T plus 1. This is what we get, the PV price, present value of the individual cash flows into T plus 1. Now, based on this, we can get the convexity number. Well, convexity is, convexity value is calculated as simply sum of PV into T into T plus 1. Okay. Sum of PV into T into T plus 1 divided by the bond value, right? Bond value multiplied by 1 plus YTM square. Okay, so this is how we calculate the convexity adjustment. So I can say convexity, just write it for you. Convexity is calculated as summation of PV into T plus 1, the whole divided by the bond value into 1 plus YTM square. Okay, so summation of bond value into 1 plus YTM square. Now, let me calculate the convexity for this question, and then we'll apply this convexity in our calculation. We'll observe that the error actually gets removed or gets reduced substantially. So we have this summation of PV into T plus 1, and then we have the bond value to be 112.16. This multiplied by 1.05 square. Okay, so we get the convexity number to be 22931 divided by 112.16 and multiplied by 1.05 to the power of 2. So we get the convexity number to be 23.71. So convexity adjustment is something what we have got, 23.71. That's the value of the convexity, guys, over here. Okay, so we computed the convexity in this way, where we took the PV into T into T plus 1. We took a total, and then we computed the convexity. Okay, is the procedure clear, everyone? Now, obviously, I won't be able to explain you the reasoning behind why we are doing this, because the basis, the statistics and the physics theorems that we have, you're not aware about it. So you won't be able to get what we are really doing over here. But yes, accept the procedure, right? So if you look at the procedure, what we need to do is we just need to add one more column over here, which is PV into T plus 1. Then simply divide that with the bond value with 1 plus YTM square. So that's 23.71. It's a convexity. So 23.71 is the convexity that we have. Now let me just make this equation complete. What was our modified duration, guys? The modified duration was 4.30. Right? So modified duration was basically minus 4.30. So we say the change that we are expecting was minus 4.30 multiplied by change in YTM. So let's say change in YTM. Let me keep it as it is. Change in YTM plus 0.5 into, we got the convexity number just now. Convexity is 23.71 into 23.71 into whatever we see the change in YTM, the square of it, right? So for 1% change in YTM, what will be the improved expected percentage change in bond value? We can simply take this same equation, but instead of now change in YTM, what should I take? for 1% change in YTM, over here, the number is going to be 1%, right? So this is going to be like, instead of change in YTM, we'll take 1%, and basically 1% is 0.01, and this is 0.5 into 23.75. Again, in place of change in YTM, we will take 0.01, because that's 1% change, so 0.01 square. And if I just solve this, what is the number that we are getting, guys? We're getting this as minus 4.3 multiplied by 1% plus 0.5 into 23.71 into 1% square. So you can see, you can observe the 4.18%. You can see that improved expected percentage change in bond value is 4.18%. And what was the actual percentage change in bond value? You see, for 1% change in the bond value, what was the actual percentage change? This was 4.18%. Now, can we see that our expected change and the actual change that we observed previously, with the error which we were having, now that error is actually totally outside the purview now, because the error has actually been removed, and we can see that 4.18% was the actual percentage change that we were observing. There we were saying that error is 0.12%. We added a convexity effect over here, and we found that percentage change in the bond value is matching with the actual percentage change in the bond value that we were observing. Is this point clear, everyone? Convexity adjustment. So we improved the percentage change, or improved the method by adding an adjustment or error correction factor called as the convexity, and that led to the improvement in the bond value. That led to the improvement in the bond value estimate, and we find that now it is an exact match. Yeah. So I hope the suspense which we had in our yesterday's class, not yesterday, but I think Monday's class, yeah. Right. So this, now it is perfectly clear. Is this perfectly clear, guys? Why we are adding that convexity? Because of the curvature. So that curvature was, diverging the actual bond value and the modified duration. Now, how do I make that modified duration line bend towards the actual bond value? By using a convexity adjustment. So when you use the convexity adjustment, the improved expected percentage change in bond value and actual percentage change in bond value are definitely going to match each other, and you will find that they are now more or less equal. Of course, it is obviously minus 4.18 because we are increasing the YTM, so bond value has to fall by 4.18%. Is this point clear, everyone? I hope we are clear with the effect of modified duration and also the convexity adjustment that we have. Are you all clear? Any doubts, any queries in this particular concept, please? Okay. Thank you, sir. Understood it clearly this time. Earlier I couldn't. Okay. So now you are clear. Fine. That's great. Okay, fine. So now, since we have understood this concept of modified duration, convexity, let's do some questions from the handout. It seems somewhat technical, but understood. Okay, that's fine. let's apply this to our question number 25, guys. The following data are available for a bond. Face value is 1000. Okay, yeah. Face value is 1000. So bond face value is 1000. Coupon rate is 16%. Coupon rate is 16%. Years to maturity. So basically, the years to maturity or time period to maturity is 6 years. Redemption value is 1000. Redemption is 1000. Yield to maturity is 17%. YTM is 17%. What's the current market price, volatility, duration of the bond? Calculate the expected market price if the increase in the required yield is by 75 basis points. Okay. The three things have to be calculated. First, the value of the bond. Second is the duration. Now, when you say duration, we're talking of the Macaulay duration. Okay. And then volatility of the bond. So volatility is basically what will be the percentage change in the bond value. Volatility is simply what will be the percentage change in the bond value due to some percent change in the YTM. So that is nothing but the modified duration. Okay. So let's take it as years and the cash flows from the bond. Then we'll take down the PV factor at the rate of 17%. Then we'll get the PV. Now to compute the Macaulay duration, we used to take the weighted average, right? So instead of, you can obviously calculate the weights, and then you take like this is the time period, and weights will be obviously denoted by, let's say, W, and then the weighted average thing will be simply W into T. Weights into T. So we have like 6 years to maturity. So 1, 2, 3, 4, 5, 6. So there are 6 years to maturity. Then let's list down the cash flows. So what are the cash flows that we have in USD? 16% is the coupon. So cash flows are going to be like 16, right? Then let's take the present value factor at 17% PV, take the weights and then weights into T. So please calculate the Macaulay duration, guys. Give me the Macaulay duration. Macaulay duration is simply sum of weights into T. Summation of weights into T. Cash flow should be 160. Yeah. And the last cash flow is going to be 1160. Okay. The last cash flow will be 1160. So complete this table, guys, because for me it's easy. I just need to drag the things, but I want you to solve this question. Take the present value factors, multiply it with PV, calculate the weights up to maybe 2 or 3 decimals, do the weights into T, and then give me the Macaulay duration numbers. Yeah. Yes. Get the PV factors, PV, weights, and then weights into T, calculate the Macaulay duration. For the ease of calculation, you can take these PV factors. You can just take the PV factors, multiply the cash flows with the PV factors, get the PV, calculate the weights, and then get the Macaulay duration. Cash flow, multiply the PV factor. Just confirm if you're getting the bond value to be 964.11. $964.40, a bit of difference, that's okay. Then simply you can take the weights, PV divided by the value. And if you take the total of weights, that should be ideally equaling to 1. Okay. Check the weights. And then final thing is to multiply weight with the number of years. If you take the summation of the entire weights, that's 4.242. So please check if you're getting the Macaulay duration to be 4.242 years. Are we getting this Macaulay duration, everyone? 4.242. Just check. Macaulay duration 4.242. Remember, Macaulay duration will be always measured in number of years. Okay. Whereas the modified duration, that will be measured always as times. So modified duration, we know it is Macaulay duration divided by 1 plus YTM. So that will be 4.242 divided by 1.17. So 3.63. 3.63 times is what we say as a modified duration. So we got the duration of the bond to be 4.242, value of the bond 964.11, and the modified duration 3.63 times. Maybe one more decimal upside, it would be 3.626 times. Yes, did we get this number? Yes, did we get this? Okay. So we're done with market price, duration, volatility. Now the expected market price is the increase in the required yield is by 75 basis point. Okay. So increase in YTM, they are stating it to be 75 basis points. Now, when we say 75 basis points, how much percentage change in YTM are we really looking at? When I say that increase in YTM is a 75 basis point, what will be the percentage change in YTM? Can I say that is simply 0.75%? So what is the expected percentage change in the bond value? What is the expected percentage change in the bond value? What will be the expected percentage change in the bond value? Expected percentage change in bond value. Can I say it will be 0.7, it will be minus modified duration, will be minus modified duration multiplied with the change in YTM, because the definition is itself that this will be minus 3.626 multiplied by change in YTM is 0.75%. So the percentage change would be 0.75% multiplied by 3.626. So the percentage change is 2.72%. Expected percentage change in bond value is 2.72%. Yes. Now, what will be the expected bond value? Expected bond value. Expected bond value will be which will be 964.11, which is the original bond value. So 964.11 multiplied by 1 minus 2.72%. So why are you doing 1 minus? Because there's an inverse relation. As the YTM has increased, the bond value has to fall. Right? So that will be like 964.11 into 1 minus 2.72%. So the expected bond value will be 937.89 days. Yes. Are we getting this? So as is value question 25. Are we getting this, everyone? 937 or 938, approximately 938. Some rounding of error is quite possible. Yep. Yes. Is that not 0.027%? No. If it is like 0.75 into 3.626, so that will be 2.72%, right? Okay, if you write it in terms of just number, it will be 0.027. But 0.027 is it's basically 2.72%. Okay. Is this clear, everyone? How to use the modified duration and Macaulay duration? Clear? Okay. Now, let's do some more questions based on this. Question number. Well, some bond refunding decision. Okay. Convertible bonds are done. Now, let's do something called as the next question, which is question number 26. Okay. Question 26, guys. Let's try to do this question 26. Interesting question. Karthik, terminology of the formula. Where is the terminology? YTMC, Karthik, what do you say? Because 4.2 for the same thing we are getting in the study material also. They've used different methods. I mean, instead of calculating weighted average by taking weights, you can simply do one thing, which is, T into PV, then whole divided by PV. Instead of calculating along with weights, you can do it with PV also. It's just the same thing. Okay. Now, let's go to question 26, guys. Please read the question number 26, everyone. Just a minute's time for you to read question 26. Read question 26, guys. Okay, let me start. So Mr. A will need 1 lakh after 2 years, for which he wants to make one-time necessary investment now. He has a choice of two types of bonds, bond X and bond Y. Bond X is having a face value of 1,000, even both are having face value of same. Coupon is 7% and 8%. Years to maturity will be 1 and 4. Current price is 972.73, 936.52, and current yield or YTM of both bonds is 10%. Okay. He requires this 1 lakh after 2 years. Advise Mr. A whether he should invest all his money in one type of bond or should he buy both bonds, and if so, in what quantity? Assume that there will be no call risk or default risk. Now, this is something we are going to understand the concept of bond portfolio immunization. Bond immunization. Okay, so what is this? Bond immunization. This bond immunization is simply trying to safeguard your portfolio. Okay, it is simply like you're trying to safeguard the portfolio because you invest in a bond, the cash flows are certain, but are you sure that the intermediate cash flows that you will be receiving, will be also earning you the same rate of return? No, because if you look at this bond X and Y, both of them are having a current YTM. I mean, if you're going to buy bond X, what is the price that I need to pay? I need to pay 972.73. That is going to mature in 1 year, and the maturity value is 1,000. So, therefore, we'll be able to see that the price working out to be 972.73. So, bond X is a 1 year bond, bond Y is a 4 year bond. My requirement of money is after 2 years. So I need 1 lakh after 2 years. I need an investment to be made, today for the realization after 2 years. So let me just make you understand that there is something called as reinvestment risk in a bond, and then we'll look at this question number 26 in detail, right? For example, let's say, for example, in our case, what is the tenure, or when do we really need the money? We'll need the money after 2 years, right? So we need that 1 lakh rupees. We need that 1 lakh rupees after 2 years. Okay. So tenure is, let's say, 2 years, guys. Okay. Now, if we have a bond, let's say, with a face value of 100, or let's say with a face value of 100, and bond with a face value of 100, and let's say coupon is, suppose for example, 10%. Current YTM is suppose 12%, right? And let's assume the tenure of the bond is 2 years. So tenure of the bond is also, let's say, same as our requirement, which is 2 years. Now, when you're going to invest in this bond, of course, you will buy this bond at its current ongoing trading price, right? So, what will be the value of the bond? Not name this. Value of the bond when we are looking for a face value of 100, coupon is 10%, YTM is, let's say, 12%, and tenure is 2 years. Can you give me the value of the bond? Value of the bond will be simply 10 multiplied by present value annuity factor at 12% for 2 years, plus redemption is taken at par value, so this is 100, into present value factor at 12% for 2 years. Okay, so 10 into present value annuity factor, 12%, 2 years. So give me the value of the bond, guys. Please give me the value of the bond. Value of the bond. Is it 96.62? Please check. Are we getting the value of the bond to be 96.62? Are we getting the bond value as 96.62, everyone? Yes? Okay. Now let's try to understand this immunization concept by first understanding why do we need to immunize our bond. Okay. Now we need the money after 2 years. We will need the money after 2 years. So today, if I'm going to invest, let's say 96.62 in this bond, what is the expected cash flows? Like year and the cash flows. First year, second year. So first year, what will be the cash flow in the first year, guys? What will be the cash flow in the first year? First year, if I'm going to invest in this bond, what will be the cash flow? 10 rupees, right? And what will be the cash flow in the second year? What will be the cash flow in the second year? 110. But this particular 10 rupee cash flow, do we need it in the first year? This 10 rupee cash flow, do we need it in the first year? Do we need this money 10 in the first year? No. So what will I do with this 10 rupee? What will I do with this 10 rupee that I received in the first year? Reinvest it, right? It's quite obvious we're going to reinvest it. Okay. Now tell me, for what tenure you are going to reinvest the money? The 10 rupee that you have, you're going to reinvest it for what tenure? Can I say for 1 year? Right? And of course, the 110 will be the final value. Now, when you're going to reinvest, let us assume that ongoing required rate of return is remaining same even after 1 year. So let's say today I'm going to invest at 12% rate. So even after 1 year, we are going to reinvest it at 1% rate. So we'll say what will be the maturity at what will be the maturity value where reinvestment rate is kept to be remaining same, which is 12%. So if my reinvestment rate is 12%, what will be the maturity value? So can I say maturity value will be 10 multiplied by 1.12, so it will become 11.2, and of course this is going to be 110. So total maturity value which you are getting is 121.2. Am I right, guys? Total maturity value which we are getting is 121.2. Correct, guys? If I'm assuming that even after 1 year, I'll be able to reinvest it at the same 12% rate. So with an investment of 96.62, I can get a maturity value of 121.2. Is this point clear? Is this point clear, everyone? Yeah. So it's quite clear that after 2 years, if I need 121.2 rupees, after 2 years, if I need 121.2 rupees, how much investment will I make today? Can I say 96.62? Right? So when you're assuming that reinvestment rate is going to remain same 12%, you're going to invest, let's say 96.62, and you will get a maturity value of 121.2. Now, if we take it a bit ahead, and now I suppose, say, for 121.2, maturity, we can buy the bond at 96.62. But are you sure that the reinvestment rate is going to be remaining same 12%? Are you sure that reinvestment rate is going to be same 12%? That, after 1 year, is the reinvestment rate going to be same 12% or is it subject to change? The reinvestment rate 12%, even after 1 year, is it going to be remaining same or is it subject to change? Can it change, guys? Can it change? Yes, it can change next year. So next year, the rate of reinvestment rate, if it changes, of course, the maturity value is also going to change. So if I say that reinvestment rate is, suppose not 12%, sir. So there is a recession in the economy, or RBI has reduced the rate of interest. So the reinvestment rate, you will not be able to find substantial other investment which will give you 12% yield. So let's say the reinvestment yield has fallen to 4%. If the reinvestment rate has fallen to 4%, will the maturity value change? Will this maturity value change, guys? If our reinvested rate, if the reinvestment rate falls to 4%, will the maturity value change? Yes, because the 10 rupee that you receive, that is going to reduce to now, that's going to just increase by 4%. So now you will find that maturity value changes. There's a change in the maturity value. Right, guys? There's a change in the maturity value. So what are we really understanding is investing in bond with the objective that in future I will receive some fixed amount. In future, I'll receive some fixed amount is subject to reinvestment risk. Am I right? It is subject to reinvestment risk. Correct, guys? Yes. So the investment amount that we have is always subject to the reinvestment risk, right? So maturity value changes. Maturity value changes due to reinvestment rate change. Okay. So if keeping a view in mind that, sir, I want some amount after 2 years. I want some amount after 2 years. This doesn't affect the main bond value. No, the main bond value will remain 110 itself. That is not going to change. The bond value, that will remain 110. That is not going to change because that is not reinvested at all. Because 110 is a promised cash flow, right, Anila? 110 is a promised cash flow by the bond. I'm not reinvesting it. So I'm getting it as a maturity on 110 itself. I'm getting that reinvestment. I'm getting that maturity value as the final value. Okay, so that is not reinvested. What is reinvested is the cash flow. So if I think that I want to, invest for, let's say I need money after 2 years, and if I buy this bond at 96.62, I required, let's say, 121.2 after 2 years, and I assume that YTM will remain same, so I'll be able to reinvest the intermediate cash flows also at the same rate. So let me buy the bond at 96.62. So when I buy the bond value and when I buy the bond at 96.62, right? We are in a position that, sir, we assume that everything is remaining same and maturity value will be 121.2. But this is not a realistic scenario. This is not a realistic scenario for a simple reason. Your reinvestment rate could change. And as the reinvestment rate changes, the maturity value will change. So you invested 96.62 with an expectation that will become 121.2 after 2 years. But what you observe after 1 year is that rate has changed. So you will not be able to fulfill your target of 121.2 or be whatever the amount of maturity that you have thought. Whatever be the amount of maturity which you would have thought, if you are going to reinvest it, if you are going to reinvest it, if you're going to reinvest the coupons, the maturity value may not be in your control and it may be subject to change. So does it make sense for me to invest in a 2-year bond? Does it make any sense for me to invest in a 2-year bond if I require money after 2 years? Does it make a sense for me to invest in a 2-year bond if I require money after 2 years? Is it certain that I will receive a particular amount on maturity? Is it certain that I'll always receive 121.2 irrespective of whatever may happen in the market? No, because reinvestment risk is what you are carrying. Right? So what could be the other alternative? What can you think of? How do we safeguard ourselves from this reinvestment risk? Sometimes people will say, some of the students may point out like this. So let us do one thing. Let us buy, let's not buy a 2-year bond. Rather, let's buy a 3-year or a 4-year bond today. And then we will, sell that bond at the second year in the market. Is it possible? Can we do that? Like instead of buying a 2-year bond, can I buy a 4-year bond today, receive the coupons for 2 years, and after 2 years, sell the bond in the market? After 2 years, sell the bond in the market. Is it possible? Yes, it is possible. But then the problem is, what will be the value of the bond when you will sell it in the market? What will be the value of the bond when you sell it in the market? Tell me. Are you sure that the value is what you have assumed will remain same? No, market price is also subject to change. So can I say there also problem is there? Sir, you said that we cannot invest in 2-year bond. We cannot invest in a 4-year bond. Why can't we invest in a 4-year bond? Because the price at which I will be selling the bond in the second year, that is subject to the yield that is ongoing in the market. So because of that, we will find that it's bit difficult for us to match our maturity amount. That's where we have this concept of bond immunization, guys. This bond immunization strategy, if we implement, we will be in a position to safeguard our position come what may. Whatever be the change in the bond value, whatever be the change in the YTM, our cash flows will be safeguarded. We will be able to realize it on maturity. First, let's understand what is that strategy. First, you understood what is the problem with this. Are we clear what is the problem? Then we will talk of the solution. Are we clear with the problem? The problem is, if I buy a 2-year bond, sir, maturity is not guaranteed. If I buy a 4-year bond, again, maturity or the final realization value is something which is not guaranteed because it is subject to change, subject to the changes in the yield. So I want a strategy which will ensure that I am getting my required amount, I am getting my required maturity amount fixed. Is the problem clear, everyone? First, tell me, is the problem clear to everyone? Then we will come to how do we look for the solution. Is the problem clear to everyone? Ankita, Poonam, Mamta, Ginny, Anila. Is the problem clear to everyone? Problem is, there is no surety about the maturity value because of the changes in the yield. As the yield changes, the maturity value is also going to change. So that's the problem which we have. So problem is clear. Now, how to solve this strategy? How to solve this strategy? This is done by something called as bond immunization. This strategy is called as bond immunization. So bond immunization strategy is invest in a portfolio of bonds with portfolio duration. Invest in a portfolio of bonds with portfolio duration equal to target time period instead of single bond with target time period. Right? So this is the strategy that we are talking of, bond immunization, where we say we are going to invest in a portfolio of the bonds with portfolio duration equal to target. Or I can say the original strategy is like invest in a bond with duration equal to target time period instead of single bond instead of bond with target time period. So this strategy says that you should invest. This strategy says that you should invest in such a bond whose duration is equal to your target time period. Like in this question 26, what is our target time period? In question 26, what is our target time period? Yeah, guys, tell me. In question 26, what is our target time period? 2 years, right? So the strategy says don't invest in a bond with a maturity of 2 years, because we observed in the example also, if you invest in a bond with a maturity of 2 years, you face problem. There is a problem because the reinvestment risk is what you are assuming. So don't invest in such single security, single tenure bond. Rather, you should try to find out such a bond. You should try to find out such a bond which has the duration of 2 years. Now, duration, we are talking of the Macaulay duration, right? So we should invest in a bond which has got a Macaulay duration of 2 years. But is it necessary that we'll be able to find such a bond in 2 years with the duration of 2 years? It may be possible that you may find a bond which is having a duration of 2 years. And if you cannot find a bond which is having a duration of 2 years, then create a portfolio of bonds which will have the portfolio duration as 2. Yeah. So the idea is, instead of investing in a 2-year bond, because why should we not be investing in a 2-year bond? Because that is subject to reinvestment risk. You should invest in a bond which has got a Macaulay duration of 2 years. You should invest in a bond which has got a Macaulay duration of 2 years. And if you can't find a bond which is having a Macaulay duration of 2 years, you should invest in a portfolio of bonds such a way that your portfolio Macaulay duration works out to be 2. Right, guys? So now in this question, bond X and bond Y. Bond X is having a year to maturity of 1 year. Bond Y is having a maturity of 4 years. Of course, we don't have a bond which is having a duration, or a Macaulay duration. First, we need to compute the Macaulay duration here. Right? So let's first compute the Macaulay duration for these bonds, guys. Okay. So let us compute Macaulay duration, because that's what we need to create a portfolio. So we'll say computation of Macaulay duration. So we need to get it for bond X as well as for bond Y. Now this is like, we take the years cash flow, right? So basically we have the years, 1 year, only 1 year bond it is. So 1 year cash flow will be only one, which is 1100, right? We'll take the PV factor. Sorry, guys. So the PV factor will be at 10%. So it's 1 divided by 1.1. And then we take the PV. Right? So we get the PV as, coupon is 7%. Right? Yeah. So last will be 1070. So present value is 972. And then what we do is simply calculate the weights. Weights is just 1. And then we do weights into time period. So that is weights into time period. So the Macaulay duration of the bond is essentially, it's just remaining the same, which is 1 year, right? So duration of bond over here, it is just 1. Now we get the bond Y. Let's write down the bond Y similar terms. Now bond Y is having a maturity of 4 years. So I'll write down like 4 years. cash flows are 8% payable annually. So cash flows are like 80, 80, 80, and that will be 1080 because redemption is assumed to be at par unless and until stated. Then we have this as 1 divided by 1.1 to the power of number of years. We get the PV factors. So those PV factors are then multiplied with the cash flows to arrive at the PVs. So that gives us the current value of the bond to be 936. And then we compute the weights. So PV divided by the total value. We multiply the weights with the time period. And then what we get is simply the summation of it. And we get the modified duration of the bond. Duration of the bond is basically 3.562. Okay, so we're getting the bonds modified duration to be 3.562. One bond is having a duration of 1 year. Second bond is having a duration of 3.562. Okay. I hope the bond modified duration calculation is clear to you. Yes, it's clear to you. Okay. Now, as I said, I need to find a bond with a duration equal to the target duration. Our target duration is 2 years. Are any of these two bonds matching my target duration? Are any of these two bonds matching my target duration? No. We don't have any bond where the duration is equal to 2 years. So what are we going to do? We will create a portfolio of bonds. In such a way that the weighted duration of our portfolio is 2 years. Okay. So now portfolio duration, we'll simply say let X be the weightage of investment. Let X be the weightage of investment in bond. What is the name of the bond? Bond X, yeah. In bond X. So can you tell me what will be the weightage of investment in bond Y? What will be the weightage of investment in bond Y? If weightage of investment in X in bond X is X, can you tell me what will be the weightage of investment in bond Y? What will be the weightage of investment in bond Y? Yeah, guys, tell me. If weightage of investment in bond X is X, can I say weightage of investment in bond Y will be 1 minus X? So as I said, weight of X multiplied by duration of X, weight of X multiplied by duration of X plus weight of Y multiplied by duration of Y is equal to, can I say it should be equal to 2? Correct, guys? Weight of X into duration of X plus weight of Y into duration of Y, the weighted average should be equal to 2 because that is what my bond immunization strategy is talking about. So weight of X is assumed to be X. So X multiplied by 1 plus weight of Y is 1 minus X multiplied by 3.562 should be equal to 2. Can you solve this and give me the value of weightage of X and weightage of Y. Weightage of investment in bond X and the weightage of investment in bond Y. Tell me. So I have to make an investment in both the bonds. Solve this equation and give me the weightages of investment in bond X and bond Y. Give me the weightage of investment in bond X and bond Y, guys. How much is it? Yep. So we can say it is 2 3.562 minus 2 3.562 minus 2 this divided by 4.562. I don't know. This should be like X plus 3.562 minus 3.562x should be equal to 2. So you can say it is minus 2.562x is equal to minus 1.562. So x will be like 1.562 divided by 2.562. Yeah, so that's like 61%, 0.61. And of course, this is going to be 1 minus this, so 0.39. So 0.61 and 0.39 is the weightage. Okay. Now, required maturity value is 1 lakh. So am I going to invest 1 lakh now? Am I going to invest 1 lakh now? No. Can I say present value of investment, right? So investment to be made today will be present value of 1 lakh. So that present value of 1 lakh will be computed as 1 lakh into present value factor at ongoing rate, whatever is ongoing rate, 10% for 2 years. Yeah, tell me guys, this is 1 lakh into present value factor. What's the present value of this? What's the present value? Simply use the PV formula also. Rate is 10% and per is 2. Is it 82,644 or 82,645? Correct? Okay, this is the investment that I need to make. Now, out of this, how much am I going to invest in investment in bond X and investment in bond Y? Investment in bond X and investment in bond Y. Can I say it's going to be 0.61 multiplied by 82,645? So that will be 82,645 into 0.61. And investment in bond Y will be 0.39 multiplied by 82,645 and 82,645 into 0.39. So can I say this is going to be our investment in the respective bonds? Yes, we will invest 50,413 in bond X and 32,231 in bond Y. Am I right, guys? These are going to be the investment in bond X and Y. Yeah. Okay. Now, can you tell me number of bonds of X to be purchased? Number of bonds of X to be purchased. Can I say it will be 50,413 divided by current market price of this bond was 972.72. 972.72. There will be this divided by 972.72. Can I say we'll be investing in 51.83 bonds? Right? So we are assuming that partial bonds is possible for investments. Okay. Now, what will be the number of bonds of Y to be purchased? What will be the number of bonds of Y to be purchased? 32,231 divided by price is how much? 936.6. So we can say the number of bonds to be purchased is 32,231 divided by 936.6. So this is so many bonds. 34.41 bonds. Right? This is the number of bonds to be purchased by us to immunize our portfolio. Okay. So when we invest in these many bonds, we will be actually creating a bond portfolio which will be having a modified duration of, or which will be having the duration equal to the tenure of ours, which is 2 years. And then that tenure is, that will be helping us to manage that bond value, which will ensure us that surely a maturity value of 1 lakh rupees. Now, how is this bond immunization strategy working for us to have that fixed value, right? I haven't yet demonstrated to you that, when you invest in these many bonds of X and Y, your portfolio is immunized, that whatever be the change in the rate of interest, you will find that your portfolio is going to give you a exact value of, your portfolio is going to give you an exact value of this of 1 lakh rupees that you want. Now that aspect, we will be taking it up post the break. So again, a suspense for you guys. Let's take a break of 10 minutes. After the break, I'll demonstrate it to you within just 5 minutes that this strategy is going to work to ensure that you get a portfolio value or you get a maturity value equal to your requirement. Okay, so let's take a break now, guys. Okay, let's begin, guys. Yes. So we have decided the number of bonds that will be purchased, right? Number of bonds of X and Y to be purchased. Now, I just want to demonstrate that whatever be the change in the YTM, whatever be that YTM, we will find that the portfolio is immunized against any change. Okay. So let's say, suppose YTM changes to, what's the current YTM, by the way? What was current YTM? 10%, right? Correct? 10% YTM. So suppose YTM changes to 9%, right? What YTM changes to 9%. Okay. Now we'll say cash flow from bond X. Cash flow from bond X. So we'll be like, in year one, we will be receiving how much from bond X, guys? What is the amount that we'll receive from bond X in year one? Can I say 1070? We'll be receiving 1070 from bond X. This is 1070, right? Cash flow from bond X is 1070. Now this will be reinvested for how many years? Because my target horizon is what? My target horizon is, what's my target horizon, guys? 2 years, right? So this 1070 will be reinvested for how many years? 1070 is going to be reinvested for how many years? 1 year, right? Because after 1 year, you're receiving 1070. So this will be reinvested for 1 year at the new rate, which is 9%. So this 1070 after 1 year will be reinvested for another 1 year at a rate of 9%. Right, guys? So 1070 is going to be reinvested for 1 year at 9%. So what will be the reinvestment? What will be the value or maturity value of reinvested cash flow from bond X? Can I say it will be 1070 multiplied by 1.09? So that's equal to 1070 into 1.09, which is 1166.3. Am I right, guys? Is this number clear? 1166.3. Is this number clear? Maturity value of the reinvested cash flow. Yes. So the bond that you purchased today of X at a price of 972.72, that becomes 1166.30 after 1 year if the YTM changes to 9%. Okay. What will be the total cash flow from bond X? Because each bond is going to be having a maturity or a total value of 1166.30. That will be, of course, multiplied with the number of bonds, which is 51.83 bonds. 51.83 bonds. So what is the maturity value? 116.30 into 51.83. So maturity value or the final cash flow that we have from bond X. From the bond X, it is now 60,446. Is the cash flow that we are receiving, the maturity value or the amount that we are receiving from bond X, clear to everyone? Is this understood, everyone? Yes. Please confirm, guys. Is this clear? Yeah. So whatever is the investment amount, each bond of X will get matured to 1070, but we don't need that money at that time. So we will reinvest it for 1 more year at 9%, and that will turn out to be a maturity value of 1166.30. You multiply it with the number of bonds. Now, next is cash flow from bond Y. We'll have like in year 1, what will be the cash flow from bond Y? What will be the cash flow from bond Y, guys? From bond Y, what is going to be the cash flow? Can I say bond Y is giving us a coupon of 80 rupees? So year 1, coupon on one bond. But am I going to take away this 80 rupee coupon? Am I going to take away this 80 rupee coupon? Am I going to take away this 80 rupee coupon? No. Coupon on one bond will be reinvested for 1 year at the new ITM, a new rate, let's say it is 9%. So what will be the maturity value of reinvested coupon? Maturity value of reinvested coupon. So coupon on one bond that we're receiving 80, what will be the maturity value of it? Can I say that will be 80 multiplied by 1.09? So that will be 80 multiplied by 1.09, which is 87.2. So maturity value of reinvested coupon is 87.2. Then in year 2, we will have the sale value or sale price of bond. What will be the sale price of the bond in year 2, guys? Has the bond matured in year 2? No, because the bond is having a maturity of, bond is having a total maturity duration of 4 years. Right? Bond is having a maturity of 4 years. So is the bond maturing in second year? Is the bond maturing in second year? No. Then can I say I'll have to sell it in the market? So what will be the price of the bond? The bond which was having a tenure of 4 years, the bond which was having a tenure of 4 years, 2 years before, what will be the now maturity period of this bond? Can I say it is having 2 years yet to maturity? So sale price of the bond will be simply present value of future cash flows. Right now, present value of future cash flows will be simply, because it's having 2 more coupons to come, right? So there will be 80 into present value annuity factor, because the new ITM is 9% for 2 years, plus 1000 into present value factor at 9% for 2 years. Yeah. What is the sale price of the bond, guys? Give me the sale price of the bond or value of the bond after 2 years with remaining 2 more years to maturity. Just calculate this, because the bond which was having a total maturity period of 4 years, 2 years before, now it has got a remaining maturity period of 2 years. So what's the sale price of the bond? Sale price of the bond. Please calculate and let me know. Okay, 981. Okay, so this is like present value. I'll take the rate as 9% and curve is 2. PMT is 80. Is it 982.41? Yes. So sale price of the bond is 982.41. So what's the total cash flow from bond Y? It will be, of course, the maturity 87.2. Will add to it coupon of 80 and we will add to it 982.41. So the total amount that you will receive from bond 2 in year 2, in the second year, the total amount that we are going to receive is 87.2 plus the last coupon, which is 80 plus 982. So this will be like 982 plus this 87 plus 80. So it's 1149.61, right? So what will be the total cash flow? This is, by the way, for one bond, right? So the total cash flow from bond Y in year 2, total cash flow from all bond Ys in year 2, that's going to be 1149.61 multiplied by number of units kitna hai? What's the number of bonds we have from Y? 34.41. So just check 1149 into 34.41. That's 39,558.04. So what will be the final total cash flow from all bonds? Can I say initially you were getting 60,446, add to it 39,558. What is the final maturity value? You can see it is include, it's going to be 1 lakh. Just rounding up error. Karthik is saying they are not going to include the reinvestment benefit of another coupon. Karthik, another coupon is issued in second year, right? And we will be withdrawing it. We will not be able to reinvest it because we need money in the second year. Got it, Karthik? Will not be reinvesting that coupon, right? Because that coupon is issued in second year. Are we able to see that the maturity value is exact 1 lakh? Some now don't argue that sir 4 rupee difference is coming. That's because of rounding up. Okay. Is it clear? Got it, everyone? The bond immunization strategy. So can we say this immunization strategy actually works by, actually works in fixing the bond portfolio value for us? So when we want to invest, when we want a particular maturity value, we are going to focus on getting the bond, getting invested in a bond portfolio or a bond with the duration equal to our target. Okay. Are we guys okay? Are we right, everyone? Did we get this? Did we get this, everyone? Okay, so that is about the bond immunization. I hope I have done justice by making you understand this concept to the best possible level, whichever extent I can. Yes. Okay. Fine. Let's take up another concept. Which is deciding whether to refund the bond early or not. Okay. So for that, we'll take up this question number 24, guys. Please read the question. Please read the question number 24. We'll discuss that question 24 now. Okay. You're welcome, Jenny. You have cleared all the sums with concept clearing, not just sum solving. Thank you. You're welcome, Jenny. Question 24, guys, just a minute's time. Please read the questions carefully, and then we'll start with the discussion about it. Okay, so ABC Limited has 300 million rupees 300 million 12% bonds outstanding with 6 years remaining to maturity. Since interest rates are falling, ABC Limited is contemplating of refunding these bonds with a 300 million issue of 6 years bond carrying a coupon of 10%. Okay. So ABC Limited has like 300 million, 12% bond. Existing bonds are 300 million with the coupon payment. I mean, we are paying a coupon of 12% with 6 years remaining to maturity. Now, when we had issued the bond, at that time, 12% was the coupon rate. So when we had issued the bond, at that time, the coupon rate was 12%. But now the coupon rates are falling, and they are saying, they're trying to look for an option to refund these bonds. Now, when I say refund these bonds, we are going to buy these bonds. We are going to buy back these bonds from the investors, from the bondholders, and make the payment of the principal and cash to them. So refunding these bonds with a 300 million issue of 6 years bonds. We will be like, let us issue new bonds and we will retire the old bonds. Okay, with a 300 million issue of 6-year bond carrying a coupon rate of 10%, issue cost of new bond will be 6 million and the call premium is 4%. 9 million being the unamortized amount of issue cost of old bonds can be written off no sooner the old bonds are called off. So issue cost of new bond is going to be 6 million and the call premium is 4%. So like when we want to issue this new bond, we'll have to shell out 6 million cost. And also call premium is 4%. Call premium means like if I want to buy the bonds from the investors, will the investors be ready to give? Because I have promised them that this bond will be from certain number of years. This bond, existing bonds are having a maturity of 6 years. And all of a sudden, if I ask them, we ask the investors that I want to retire the bond, I want to buy back the bonds from you, and will they be giving me at par value or will they be asking for some premium also? They'll be asking for some premium also, right? Yes or no? Am I right, guys? Right. So I need to pay a premium of 4% to them. So whatever is the value, whatever is the face value of the bond, I will give you 4% of that as a premium, and I will buy the bonds from you. So 9 million being unamortized portion of issue cost of old bonds can be written off no sooner the old bonds are called off. So we have like issue expenses or preliminary or issue expenses of old bonds which we haven't yet claimed in income tax. So that can be claimed as soon as we retire the old bonds. So like whatever will be the issue expenses, that will be you have 9 million which is not yet claimed against income tax. Now of course you will be getting a tax saving on that. Okay, you are required to analyze the bond refunding decision. So we have to look for whether we should be able to retire the bonds early or not, or we should retire the bonds early or not. Now again, in this question also, we are going to take the decision based on the concept of NPV, net present value calculation, right? So net present value will be computed, and if the NPV turns out to be positive, we will be, retiring the bond. And if the NPV is not positive, if it turns out to be negative, then we will not be retiring the bond. Okay. Now, let's first talk of what will be let's first talk of what will be the initial outlay. What will be the initial outlay? So we'll say calculation of initial outlay. Like today, if I decide for redeeming the bonds, I can say refunding or retiring the bonds, then what sort of cash flows are we going to get? First, the face value. Of course, it's going to be the 300. These are in millions. Okay. I need to pay the face value, of course. But am I going to redeem it at face value? No. I need to pay a premium. Right? I need to pay a premium to retire this. So what is the premium that we are going to pay? Add call premium. What will be the premium? I won't be paying only 300. I will be paying something additional also. So what will be the premium? Call premium was at 4%, right? The call premium at 4%. The face value is like 300. Call premium is 4%. So what will be the amount of call premium? I need to pay 4% extra. So which means I need to pay 12 extra. So cost of retiring or calling old bonds. So if I'm going to retire the old bonds, I need to pay actually 312. I need to shell out 312 rupees. So cost of retiring or calling of old bonds, I need to pay 312, right? Now, apart from this, this is the cost of retiring of old bonds. How much am I going to receive? Gross proceeds of new issue. If I'm going to retire the old bonds, I'm going to issue new bonds. The new bonds that will be issued is 300, right? And then, of course, from this, we're going to subtract the issue expenses. How much is the issue expense? 6 million. Okay. So how much am I going to receive the net proceeds? Net proceeds will be, can I say 294? The net proceeds that I have is 294. I need to pay 312. I need to pay 312. I'll be receiving 294. Also, one more thing that's happening is tax savings on call premium, because we are paying this additional cost. So on this 12 rupee, we'll be of course saving 30%, right? So it will be 3.6. Then tax savings on the tax savings on call premium is of course 3.6. And then tax savings on one more thing, we are going to save tax. We'll be saving the tax on unamortized portion, which is 9 million. So tax savings on unamortized portion. The unamortized portion was 9, so that multiplied by 30%. So it will be like 9 multiplied by 30%. 2.7 is going to be the tax saving, right? So what will be the net outlay? Net initial outlay will be 312. This will be the cost. Net initial outlay 312. You will be receiving 294. Also, you will be saving 3.6 and 2.7. So initial outlay will be 11.7 million, guys. So 11.7 million is what we are going to pay. Are we getting it, everyone? Is the initial outlay calculation clear to you? Is the initial outlay calculation clear to you? Yep. Okay. Now we have to calculate the NPV for this. Unamortized portion. Can you explain the concept of unamortized portion? See, Ginny, this bond, the old bonds which we had, we would have issued it some years before. Now, can I say at that time, we would have some issue expenses, some floating costs would have been there. Now, those floating costs are, not tax deductible, right? Not tax deductible in 1 year. They are going to be, amortized over a period of years or over the period of the bond existence. So, like if let's say initial issue expense is let's say 10 crore, and your bond tenure is 5 years. So you are going to claim that unamortized, you are going to claim that issue expenses 2 crore every year, right? So 5 years is the time of the bond. 10 crore was the issue expense. So every year you are going to claim 2 crores. Now, if you still have, let's say 3 years to maturity, can I say you will still have 6 crores of issue expense which you haven't claimed in income tax, right? That is what we have over here as the unamortized. So 9 crore was the unamortized portion, which haven't been yet, claimed with income tax. So we are taking a tax saving of that. Okay. So because when the bond is being bought back, we don't want that preliminary expense or the issue expense to be left. So that will be written off. Okay. Fine. So we've got the net initial outlay. Now we have to calculate the NPV. Okay. So let's do calculation of NPV. Now NPV will be like here. Let me take it as particulars here. Particulars. Here, cash flow, PV factor, and then the PV. Okay. Now, first thing, of course, this is the initial outlay. This is in year 0. Cash flow is 11.7, which will be negative. PV factor is 1. Of course, PV will be this number. Then, what will be the cash inflow and outflow over here? First, we will say, what is the savings in the annual interest expense? Savings in annual or savings in interest. What will be the amount of savings? Can I say earlier, the old bonds were requiring a coupon payment of 12%. The new bonds will require a coupon payment of 10%. So can I say it will be like on 300, we are saving 12% minus 10%. Right? So we are saving is 2% on this. So what will be the years of saving? Years of saving will be from year 1 to 6. So total tenure that we still have is 6 years. So year 1 to 6. What will be the savings in the interest that we are going to have? From year 1 to 6, savings and interest will be 2% of 300. Can I say 6 is an inflow for us? 6 is the inflow for us. Right, guys? We'll write down the PV factor later and then simply multiply it. So savings and interest. Then what are other things are going to happen? Obviously, on this interest, since your savings is happening in interest, we need to pay the tax on savings and interest. So this is like tax on interest saved. Again, this will be from year 1 to 6. What will be the savings in interest? Can I say 6 rupee multiplied by 30%? So can I say 1.8 will be the savings in interest that will have tax expense due to reduction in the interest that you're saving. Due to that, you're going to pay tax. So of course, this is going to be your cash outflow. Correct, guys? 1.8 will be your cash outflow. Right? Then we will say tax savings not tax saving, but rather I can say tax on incremental amortization. Tax saving on incremental amortization. Now, tax saving on incremental amortization will be, what is the incremental amortization? Tax saving on tax that we need to pay on incremental amortization. What was the amortization that was carried out earlier? It was 9 divided by 6. Right? Because remaining was 9. So 9 will be divided by 6. And what will be the tax on the new amount? The new amount is like 6 crore is the issue expense. That is going to be amortized over a period of 6 years. And of course, that multiplied by 30%. This is also going to be from 1 to 6. So it's like earlier, we used to have 9 by 6, then minus 6 by 6, this thing multiplied by 30%, so which is 0.15. So I need to pay this extra tax of 0.15 due to the increased amortization, because earlier the amortization was 9 divided by 6, which is 1.5. 9 divided by 6, which is 1.5, right? And 9 divided by 6, which was 1.5. And over here, now I will be claiming amortization of only 1. So earlier the amortization claim was 1.5 million. Now it is 1 million. So I need to pay a bit more tax, because in future I'm going to have that extra tax payment of 0.15. And then we'll take the PV factor. Now for PV factor, we need to look at coupon rate of 10%, issue expense. Issue cost is this. At what rate should I calculate the PV? Obviously, I need to calculate the cost of debt. So what will be my cost of debt? What will be the cost of debt? What's the coupon rate we are offering on the new bonds? Carrying a coupon of 10%, right? So they're carrying a coupon of 10%. So 10% is the coupon that you're paying. So 10%, that will be, multiplied with 1 minus 0.3. So that is essentially 7%. So cost of debt is 7%. So we can get the present value factor at 7%. What is the annuity factor, guys? Tell me, what is the annuity factor of at 7% for 6 years? Give me the number. Present value annuity factor. Give the present value annuity factor at 7%. What's the present value annuity factor at 7%? 4.767. Okay. 4.767. Cash flow into PV factor. We can simply take the total of all of them. And we find the NPV to be 7.61. So since the NPV is positive, should we go ahead with refunding the bond? Since the NPV is positive, should we go ahead with refunding the bond? Yes. So your decision will be the bonds should be refunded. The bonds should definitely be refunded. Okay. Yes. Fine, guys. So that is question number 24, which is done. Okay. Now let's do some questions. Okay, Karthik, so if you consider if amortization amount is increased, tax saving will be more. Then isn't it should be cash inflow? Amortization amount is decreasing, Karthik. Earlier it was 1.5, now it is 1. So of course there will be a additional tax that you need to pay. Earlier amortization expense is 1.5 because that was 9 for the remaining 6 years, and here we have 6 for the 6 years. So that will be 1.5. So before retirement, the amortization per year was 1.5, but after retirement, the amortization will be 1. So there will be a reduction in the amortization, and therefore you need to pay tax. First part is clear? Yeah. Right. Then also, why have we not considered bond redemption at the termination? Bond redemption is not an incremental cash flow because redemption would have taken place even if you wouldn't have retired the bond today. Like even if you wouldn't have retired the bond today, the old bonds would have been redeemed at same value even in future. So incremental redemption value is not there. All these are incremental, right? Old minus, old versus new. Redemption value of old bonds was also 300, new bonds is also 300. So there's no incremental cash flow from it, and therefore that is ignored. Okay, great. Now, let me just take some question. Let's try this question number 17. Rahul Limited has a surplus cash of 100 lakhs and wants to distribute 27% of it to the shareholders. The company decides to buy back the shares. So this guy Rahul, this company is having a surplus cash of 100 lakhs and it wants to distribute 27% of it. So what is the amount of distribution that the company is looking for? What is the amount of distribution that the company is looking for? Can I say 27% of 100? 27 lakhs? The company decides to buy back the equity shares. So company wants to buy back shares by paying this 27 lakhs. Then the finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price. So the finance manager is saying that the value of the shares after repurchase is going to be 10% above the buyback. So whatever is the buyback price, the price in future is likely to be above 10% above the buyback price. If the buyback route is taken, the number of shares outstanding at present is 10 lakhs and the current EPS is 3. You're required to determine the price at which shares can be repurchased. If the market capitalization of the company should be 210 lakhs after buyback. So total market capitalization means total value of all the shares. So we say total value of all the shares should be 210 lakhs after buyback, right? So after buyback, the market capitalization will be obviously derived at after buyback price into original minus the shares bought. Now, do we know the number of shares outstanding? Yes, which is 10 lakh. So this is our question number 17. So question 17, market capitalization should be 210 lakhs. So we want we have the existing number of shares. Existing number of equity shares is 10 lakhs, right? Has the question specified the number of shares to be bought back? No. But we will say we don't know even the price at which the shares will be bought back. So let us assume let P be the price at which shares will be bought back. So if P is the price at which shares will be bought back, can you tell me what will be share price after buyback? What will be the share price after buyback is? If P is the price at which we are going to buy the shares, what will be the share price after buyback? If P is the price of the share at which we are going to buy back, we'll buy back one of the shares, each of the shares that we're looking for at P. So the price after buyback is obviously 1.1 P. Because the question states that the repurchase price is likely to, after repurchase, the price is likely to be 10% above the buyback price. Okay. So now, amount available for buyback. Can I say it is 27 lakh? Right, guys? Amount available for buyback is 27 lakh. So therefore, number of shares to be purchased will be, what will be the number of shares that will be purchased? Can I say 27 lakh divided by P? Right, 27 lakh divided by P. Okay. Right. Now, what will be the number of shares left after buyback? Number of shares that will be left after buyback. So it will be like 10 lakh minus 27 lakh divided by P. So what will be market capitalization after buyback? Market capitalization after buyback will be, can I say 1.1 P multiplied by 10 lakh minus 27 lakh. 27 lakh divided by P. And what is the market capitalization that we want after buyback? Can I say it is 210 lakhs? So we say that this should be equal to 210. So 1.1p into 10 lakh minus 27 lakh by p should be equal to 210. Can you solve this? Can you solve this? Yes, so that will be like 11 lakh. It's 10 lakh, right? So that will be 11 lakh p minus 27 lakh will be equal to 210 lakhs. 110 lakhs. Yeah. So what will be the value of P? So 210 lakh minus 27 lakh. This entire thing divided by 11 lakh, which is 16.63. Is it? Or there's a mistake? 11 lakh into P minus 27 lakh should be equal to 27 lakh will be added. 21.54. Right? Oof, I made a mistake. Yeah. So price is 21.54, everyone. Is it right? 27 lakh will be added to this term divided by 11 lakh. 21.54. 1.1p. Yeah, this will be also 27 lakh will be multiplied with 1.1. Correct. So this will be 1.1 into 27. 1.1 into 27 will be 29 lakh 70,000. This will be 29 lakh 70,000 divided by 21.79 is the price of the shares. Or we can say the price at which the buyback will happen is 29.79. Okay, then the next part is the number of shares that can be repurchased. So what will be the number of shares that can be repurchased? Number of shares that can be repurchased, can I say 27 lakhs divided by 21.79. 27 lakh divided by 21.79. So that is like 1,23,910. These many shares can be repurchased. Then the impact of share repurchase on EPS, assuming that net income is same. So if your net income is going to remain same, we need to get the net income. Net income will be, of course, EPS into number of equity shares before buyback, right? So EPS is given in the question. Impact of share repurchase on EPS. So current EPS is 3. So I need to get the net income, which is EPS was 3. So 3 multiplied by number of equity shares before buyback. What is the number of equity shares before buyback? 10 lakhs. So net income was 30 lakhs. Right? Net income was 30 lakhs. Now we will say what will be the new number of shares or number of shares after buyback. Number of shares after buyback. This is 123,910. The number of shares that are repurchased, right? So it will be like 10 lakh minus shares bought back. So this is 10 lakh minus the shares bought back is 123. And so we say this 10 lakh minus this. So 8,76,090. This is the number of shares that we have after buyback. Now, EPS after buyback will be net income after buyback upon number of shares after buyback, which is simply the net income, that's a constant number, divided by number of shares after buyback. So that's like 3.43. 3.43 will be the EPS after buyback. Okay. EPS is 3.42 after buyback. Yeah. Okay. We haven't done question 13, it seems. Right? Question 13. Sure if that's done. We have completed almost all sums of test your knowledge with you as these are present over there. Thank you, sir. Okay. Earnings based, then we have been like looking for. No, we haven't done that question 13. So let me just quickly do that question 13 with the remaining time in hand. X Limited has paid a dividend of 2.5 per share. So he has paid a dividend or has paid a dividend. So of course, what is this has paid means? 2.5 means it's a D0 or the dividend paid in the last year. On a face value of 10, ending 31st, the details are as follows. Current market price of the share is 60. Growth rate of earnings and dividend is 10%. Beta of the company is given as 0.75. So we have the growth rate. We have the growth rate as 10%. Okay. Then after growth rate, we have got the beta of 0.75. So beta is 0.75. Then we have average market return and risk-free rate. So we have like market rate of return. So market rate of return is, average market rate is 15% and risk-free rate of return. The risk-free rate of return is 9%. Okay. Beta is 0.75. We want to compute the intrinsic value of the share. Now to get the intrinsic value of the share, this will be, price of the share will be simply D1 divided by KE minus G. Now we need to first get the KE value here. So KE will be computed as risk-free plus beta multiplied by RM minus RF. So KE will be 9% plus 0.75 beta into 15% minus 9%. So KE will be 9% plus 0.75 multiplied by 15% minus 9%. So that's 13.5% is the KE. Now we need to also get the D1. So D1 will be simply D0 multiplied by 1 plus the growth rate. So we know D1 will be 2.5. To that will multiply by 1.1 because the growth rate is 10%. So we know K, we know D1, we know growth. I can simply get the intrinsic value to be 2.75 divided by K of 13.5% minus growth rate of 10%. So that gives us the price to be 2.75 divided by 0.035. Yes. So intrinsic value is 78.57. Simple. Okay. Good. So now, yeah, guys. Okay. So this is done. Now, yeah, with that, we'll stop my part. You have any queries, you can definitely take it up right now.
Any student can ask any query.
So can we take that question now?
Which question, beta?
So MTP2 case scenario.
Ani, beta, I remember. I will take in the next class. Okay, don't worry.
Okay. Sir.
Okay, sure. In the next class, I will take it. Okay. Okay, student. Hi, please.
Yeah, Mamta.
Mamta, beta, I think you are on mute. देखना जी अनम्यूट कर दिया हमने उनको.
It was maybe unmuted by mistake, sir, probably.
Okay.
Sir, in question number 25, we can calculate simply expected bond value. Then expected bond value in simple manner. Then why we calculated in weighted WAT expected bond value like that.
Weighted where? Which question number?
25.
25. Question 25.
This one.
This one. We wanted
Yes.
the current market price and also duration and volatility, right? So we need to calculate this part. Expected bond value is calculated the expected market price. This is not the actual market price. Actual market price will be based on the actual YTM that we observe. So we are looking at the volatility. This is a hypothetical scenario that if the yield is changing by 75 basis point, what is the expected change in bond value and what is the resultant impact on the bond price? Okay.
Okay, sir.
Yeah, so we are, it's an expected market price. It is not the actual market price that we look.
Okay, sir.
Okay. Any other queries?
Okay.
No, I don't think. No.
Okay, student, in the beginning of class, someone student has sent the chat, sir, what is the logic of this formula? Okay. Now, student, please note that the derivation of any formula is not covered in your syllabus. Normally, what happens? There are two type of formulas. One are driven by the logic, and another was are driven by the mathematical calculations and very advanced mathematical calculations. So generally, what happens? For this type of formulas, we don't cover it in the class because these classes only for the base, because we have to apply the formula only. Okay, so don't worry, don't go into the too much detail, because simple mathematical formulas are there, but not, and they are with the advanced calculation. And one more thing, now in the last question that sir has covered, you have observed one thing. Here we are applying the model CAPM model. This is called capital asset pricing model. So this CAPM model will be discussed in more detail when we shall take the chapter of portfolio management. So this way you can see that any question can be a combination of more than one topic. So that's why we always say that student don't skip any topic, because suppose if any student go for a security valuation, he is well versed with the security valuation concept, but if he has ignored the topic of security valuation, then he will not be aware about the chapter of the this concept of CAPM. So that's why please go through. You should not leave any topic untouched. Student, with this we come to the end of the session, and as I told you in earlier class, if you have any query, you can send it to the at a mobile app, or you can send it at by email at this address. Okay, or you can contact me at this number. Raj, exactly what do you want me that I should explain in the next class of yield curve? Just get me know just again. Raj?
He's left, sir. I think he's not. He's there.
Okay, because I think because
I'm not allowed to unmute.
okay, no, not allowed.
I think so. He wants this solution for that MTP2 case scenario 3 answer.
That I know, but when any additional point he wants to cover, then I will. Okay, no problem. Okay.
Sir, I have one to additional point is that using the study material, what is written in study material, can you apply that in that question?
Using the study material. Okay.
Okay, the text is very different there, and the application is totally different. I'm not matching it. Like what is in study material and the question is completely different.
Okay. Can you do one thing if possible for you? You can contact me over this telephone number.
I will call.
You or you do one thing. There is email ID on your screen now.
Yeah.
You just send me your contact number. I will contact you.
Okay, sir.
Okay. You
Okay.
do one thing. Only just you send me the contact number. I will contact you. Okay.
Okay, sir.
Okay. Then. Okay, student. Thanks for patient listening for this session, and thank you, Jagbandhu sir, for enlightening the student on this class. Now, student, please note that in the next session, we shall continue this topic of the security valuation, and it will be covered up. Then after that, we shall start with the topic of portfolio management. Yes, sir. Okay, sir.
Yes.
Okay.
Yes.
So now till that, you can practice the questions, and if any queries there, please discuss with us. Thank you, sir. Thank you, student. And thank you, sir. Thanks a lot, sir.
Thank you, sir. Yes, yes.